In 1987, the future felt loud. Milan shimmered under neon lights, tailors stitched power suits, factories hummed through the night, espresso cups clinked like tiny victory bells. Italy had just climbed past Britain to become one of the world's largest economies. Growth felt permanent. Money felt easy. Confidence felt earned. If you stood in a crowded piazza back then, you could believe the momentum would last forever. Now look at 2025. The music is softer. The growth charts are flatter. The optimism is thinner. While other advanced economies expanded, modernized, doubled in size, Italy barely moved. Output per person hovers near where it stood at the turn of the millennium. A quarter century of motion without distance. How does a country famous for reinvention become stuck in time? The answer is uncomfortable. The weakness was planted during the strength. For decades, Italy relied on a silent advantage. When competition intensified, the currency would quietly lose value. Overnight, exports looked cheaper. Manufacturers gained breathing room without changing much at all. Imagine two factories. One invests in robotics and precision. The other keeps older machines but wakes up to a weaker currency that suddenly makes its products cheaper abroad. Which owner feels urgency to upgrade? Temporary relief replaced structural reform, but devaluations have consequences. A weaker currency makes imported energy and raw materials more expensive. Inflation rises. Wages chase prices. Costs climb again. To contain social unrest, wages were often indexed to inflation. That meant every price increase triggered automatic pay increases. Businesses faced higher expenses, then demanded another devaluation to restore competitiveness. It was a loop, a comfort loop. When Italy adopted a shared European currency at the end of the 1990s, that lever disappeared overnight. There would be no more quick fixes through exchange rates. Suddenly, companies had to compete on productivity, innovation, and scale. And many were unprepared. Productivity is the quiet engine of prosperity. It measures how efficiently a nation turns labor and capital into value. Since joining the Euro era, Italy's productivity growth has been among the weakest in the developed world. In some sectors, it stalled entirely. Why? Look at the structure of business. Italy is a nation of small firms, family workshops, artisan producers, micro-enterprises with fewer than 10 employees. They are charming. They preserve tradition. They define the brand of the country. But scale matters in a global economy. Large firms invest heavily in research. They spread fixed costs across millions of units. They build international supply chains. Tiny firms survive month to month. They hesitate to borrow. They avoid risks that might double their size, but also double their exposure. Regulations reinforced this smallness. Crossing certain employee thresholds triggered stricter labor rules and higher compliance burdens. For many owners, staying below the line felt safer than expanding beyond it. So companies fragmented, growth slowed, productivity drifted. Leadership structures often remained within families. Sometimes that continuity preserved culture. Sometimes it limited fresh ideas. In competitive markets, talent and merit need room to rise. While other nations built global tech champions and scaled industrial giants, Italy multiplied boutique producers. Excellence in craftsmanship cannot alone sustain an entire G7 economy. Then comes demography. Economic growth requires people. Workers create output. Consumers create demand. Italy's birth rate has fallen well below replacement level. Each year, fewer children are born than in the one before. Entire villages shrink, schools close. The age structure tilts upward. A growing share of citizens are retired, supported by a shrinking base of working-age adults. Public finances feel the strain. Pension spending absorbs a large portion of national output. Funds that could build digital networks or modern transport instead flow toward sustaining past promises. Politically, older voters hold weight. Reforming benefits is difficult. Raising taxes on younger workers becomes tempting. But heavy taxation and limited opportunity push young adults to delay families. Lower births today mean fewer workers tomorrow. The cycle reinforces itself. Demography moves slowly, yet its effects compound relentlessly. Next, the state itself. Entrepreneurs describe an administrative maze. Permits take months. Court cases last years. Contract enforcement is uncertain. Imagine supplying goods to a client who refuses payment. If legal resolution stretches across several years, small firms may collapse before justice arrives. Complexity breeds caution. Investors seek predictability. If rules shift frequently, capital waits elsewhere. Italy possesses extraordinary human talent and geographic advantages, yet bureaucratic delay acts like friction in every transaction. Friction reduces speed. In a global market, speed defines competitiveness. Then there is the exodus of youth. Educated graduates compare domestic wages with opportunities abroad. In many cases, salaries in Northern Europe or North America are significantly higher. Career progression appears faster. When ambitious engineers, scientists, and designers depart, the nation loses not only taxpayers but innovators. Education systems continue producing skilled minds, but the return on that investment is realized in foreign laboratories and companies. Brain drain becomes both symptom and cause. Weak growth encourages departure. Departure weakens growth further. Regional imbalance adds another layer. Northern Italy integrates tightly with Central European supply chains. Manufacturing clusters connect to global markets. In parts of the South, infrastructure gaps and historical underinvestment hinder private enterprise. Unemployment remains higher. Public employment plays a larger role. The contrast within one country is stark. Two economic realities share the same flag and currency. Bridging that divide requires sustained investment, efficient governance, and trust. Without it, national averages conceal deep fractures. Above all hovers debt. Public liabilities exceed annual national output. Servicing that debt consumes billions each year. When interest rates remain low, the burden feels manageable. When markets grow nervous, borrowing costs rise quickly. High debt limits flexibility. In downturns, governments typically stimulate economies through spending or tax relief. Heavy obligations constrain those options. Thus, growth remains modest. Modest growth makes debt harder to reduce. Another loop emerges. None of these factors alone condemns a nation. Many countries face aging populations or complex regulations. The danger lies in their interaction. Low productivity restrains wages. Low wages discourage family formation. Demographic decline strains pensions. Pension pressure increases taxes. High taxes dampen entrepreneurship. Bureaucratic delay discourages investment. Investment shortfalls limit productivity gains. The web tightens gradually. Yet Italy is not without strengths. Private household wealth remains significant. Savings rates historically outpaced several peers. Cultural industries command global admiration. Tourism, design, luxury manufacturing, and specialized engineering still generate value. Small firms, though limited in scale, often exhibit remarkable quality and flexibility. The question is whether these assets can be translated into sustained modern growth. Reform requires trade-offs. Simplifying labor rules may unsettle workers. Adjusting pensions may anger retirees. Cutting red tape challenges entrenched interests. Political courage becomes essential. History shows that Italy has reinvented itself before. After the devastation of the mid-20th century, it engineered a rapid industrial ascent. Creativity and resilience are not in short supply. But time matters. Demographic decline does not pause for debate. Global competition accelerates. Digital transformation rewards those who adapt quickly. Will Italy nurture larger, more innovative firms without losing its artisanal soul? Can it streamline governance while preserving social protections? Can it make opportunity attractive enough that young graduates build futures at home rather than abroad? These questions define the coming decades. Economic stagnation rarely announces itself with drama. It arrives quietly year after year until the gap between memory and reality becomes impossible to ignore. In 1987, prosperity felt effortless. In 2025, progress demands discipline. The story of Italy is not predetermined decline. It is a contest between habit and adaptation. Currencies can no longer be weakened to mask inefficiency. Demography cannot be reversed overnight. Debt cannot vanish by wish. Only sustained productivity growth can shift the trajectory. That means investment in technology, education aligned with industry, efficient courts, transparent rules, and space for talent to rise on merit. Such change is incremental. It lacks the spectacle of crisis. But without it, the distance between Italy and its faster-growing peers will widen. A nation celebrated for Renaissance breakthroughs now faces a quieter challenge, renewing itself in the 21st century. The piazzas are still beautiful, the factories still operate, the creativity still exists. The question is whether structure will match spirit, because economic vitality is not guaranteed by history. It is earned continuously. The party of the late 20th century ended long ago. What comes next depends on choices made today. Stagnation is a condition. It is not a destiny.